Hi, good afternoon. Welcome to the September 24th, 2021 version of our News from the Front Lines of Business podcast here with DW Huff Consulting. So we're a small business CPA firm here, if you haven't already dealt with us. We help you know your numbers and try to run your business more efficiently, as well as, of course, save tax and kind of grow your wealth. And just as another side note, any information you see later on is not intended to be a specific recommendation to you. You should always reach out to your own CPAs, attorneys, or other counsel before taking action on anything that you've learned from our podcast. Okay, so this week, our decent amount of things going on, but before we jump into the kind of the hard work here, our fun with numbers for the week is 0.37 or 37 cents. So we talked a lot about investing and the importance of trying to grow your assets, whether it's in a retirement account or whatever it is. And we, sometimes people will be, I guess, more conservative and want to put that money in a bank account that throws off, a fraction of 1%. And just to show, I guess, a quick reason why you have to do more than that with any type of asset is the growth in the price of a Whopper. So here we got a Burger King Whopper. So hopefully you live in a place where Burger King gets better service than here in Chalmette, because getting a Whopper is an ordeal. But in any case, if you wanted a Whopper, when this thing first started in 1957, 37 cents would get you a single there, a Whopper. But compared to today, it's $4.99. So $5 hamburger today. So if you, in 1957, if you took $1 and put it in a coffee can in the backyard, you could have bought 3 Whoppers, a two plus Coke probably, right? With that same dollar. Now you couldn't even get a couple bites of a Whopper for $1. So it kind of shows you how your money, you got to do things with it that'll make it grow and keep up with at least inflation. So at least if you had enough money to buy a Whopper in 1957, you'd still have enough money to buy one now. So this is a side note, something to keep in mind as we discuss investment choices and knowing our numbers and growing your money. All right, so news from the front. So this week's been kind of busy. Actually towards the end of last week, the Building Back Better Act came about. So that's the kind of unofficial name of this legislation that's currently in the House Ways and Means Committee. And it's a pretty comprehensive, sweeping tax reform that has been sold by the Biden administration as making the top 1% pay their fair share. So it's supposed to be an attack on rich people, I guess. Top 1% and making them pay their fair share. And so without getting into politics or the progressiveness of the tax code, there's all kinds of things in there. Higher tax rates across the board, higher tax rates on capital gains. And it's one provision that really jumps out at me as being bad. So everything else is kind of, I guess, can be seen different ways. But this attack on the self-directed IRA, or SDIRA as I have here, those are a tool that you can use to invest in things that are outside of your regular mutual fund or stock market type, brokerage account type thing. So you can invest in some real estate, possibly cryptocurrency. It opens up pretty much a wide range of investment choices that you can hold in your IRA account. And we're going to go into a little more detail in a second as to what exactly they're doing. But the new act does some things that dramatically curtail the ability to do that. And tax code. So as you know, the tax code is, I forget how many thousands of pages long, but we clearly see in the tax code that and there's every single line in every single page of that tax code and every single bill that ever gets proposed is always because some political action committee or some donor has given some politician some money to put some kind of carve out in the tax code that helps them, or alternatively hinders someone else. And that's what we kind of feel like what's going on here. Because as you look at this, some of the examples we've been throwing around is this guy, I forget his name now, but he is an investor in PayPal and a couple other tech startup things, and somehow his IRA got to be $5 billion. So this legislation hurts him. It also helps, I guess, you more of your, I guess, traditional, Wall Street investment type firms. So curious to see who's really kind of behind these things. And then, as we look at that, we also going to chat a little bit about, do really need your traditional investment advisors. So with that, we'll kind of go into a little more detail. So the self-directed IRA, so that's really my big focus this week, because this is something we started to use with clients recently. As of 4 or 5 years ago, these type of investment accounts were very expensive to manage and they're just out of reach to the ordinary Main Street investor. Now they're very accessible. We'll talk about some of the details as to why that is now. But a self-directed IRA, it doesn't mean you're just picking and choosing stocks and mutual funds in your own account. It lets you go into, I guess, all different types of investments. So privately held companies are eligible. So there's rules, so be careful about how you go about it, but there are rules. So this is one slide I pulled up here. You can invest in real estate, so you can have a rental real estate. You can buy property as an investment. Non-traded businesses, so they give this example of a horse farm. So it's publicly it's not publicly traded, but you can invest your assets in that type of company here. And so some of the things that be, I guess, aware of, that you do need to have a trustee, and you have to set these things up properly, right? So we have to go through some steps on the front end with certain legal documents and certain provisions in order to make them eligible. But once you get to that point there, you can, I guess, have the potential for a higher portfolio value increases, because a lot of times you can hold things that you have a more intimate knowledge of. So if you're very well versed in the real estate in your local market, or you have some small business that the owners possibly in your local area that you can invest in, those things are now eligible to be put in here. So you could possibly, as opposed to going to something that you don't know anything about, some XYZ mutual fund somewhere, you can invest in things you know and understand and have a potential for a much bigger return than the 8 to 12% that the stock market would provide, depending on which asset class you're looking at. So, so the self-directed IRA versus ordinary IRA in this example here is just like your regular thing, that just mutual funds. So your Vanguard, your S&P 500s, just any kind of mutual fund that you've ever heard of, that you've probably seen in 401k plans and things like that. That's what would be considered to be ordinary, versus that's traditional. So the self-directed is real estate, private companies, precious metals are available, oil and gas partnerships, mortgages. So these IRAs can lend money to other people and collect interest. Promissory notes, livestock, just anything outside of the stock market you could think of is available. So I guess you can see why we talk about why this legislation is kind of being pushed and who probably is behind it. Because if you have people, regular Main Street type investors who are now not investing in XYZ mutual fund companies' portfolio there, Wall Street loses a lot of money. Because as of now, the Investment Company Institute had a study back in 2014, just across the board, average expenses of 1.37%. Self-directed IRA fees are a lot less than that, because they're just a fixed dollar amount based on some annual filings that need to take place. So my example here at the bottom of a $300,000 investment, it was in a mutual fund account. Now you got $3,000 plus of cost every single year to keep that asset going. Whereas if you have a $300,000 piece of real estate inside of your IRA, that's only going to cost you about $1,000 in cost. So so you have basically $2,000 more money you have inside your portfolio that's going to continue to grow and help you increase that account size. So anyway, so the building back better. So I got to really put my question marks at the end of that here, because if they take this off the table, this particular thing off the table, we're not building anything back. It's going to be punishing some of these small investors unintentionally. The people who are regularly in these accounts and have less opportunity for diversified investments, and of course, portfolios managed by the Wall Street firms going to see more money as these things that are currently in place are going to need to be liquidated, and and money's got to go somewhere, right? So anyway, bad news all the way around. So I think I sent out some emails a while back. If you have an opportunity to write to your representatives and have them remove these two provisions, that would be good. So that's it for this week, guys. And that whole thing with IRAs has been my my whole focus this whole week, because it's just a bad deal and it's something we've been utilizing with great success. So as we enjoy this nice weather here out here in Chalmette, we're looking at 75 degrees and no humidity, and it's going to be that way all weekend. So I would encourage everybody to get out and enjoy themselves. But I quoted Epictetus here. So as you remember, I've been reading a lot of Stoic philosophers, and he's one of the biggies here. And he says, he is a wise man who does not grieve for things he has not, but rejoices for those which he has. So an attitude of gratitude is that's what we're trying to get across here. And as we seeing some of our brothers and sisters out there in Terrebonne and Houma and all the people that are affected by Hurricane Ida are still, in some cases, without power, definitely spend a lot of time doing cleanup and work stuff. Just be grateful that it wasn't as bad for a lot of people as it is for others. And yeah, enjoy your weekend and enjoy the good weather, and we'll see you next week.